this video, I'll go through Chapter 1, Lesson 1, Work Together, which is on page 12 of your textbook. It says, determining the normal balance, increase and decrease side for accounts. Write the answers to the following problems in your working papers, which I've provided here in a Google Sheet. And your instructor, that's me, will guide you through the following examples. For each account, complete the following. Prepare a T account. Enter the title of account. I've already done that for you. And then we need to identify whether it's an asset, liability, owner equity, revenue, or an expense. We get that in a drop-down menu. Okay, and then we'll label it as a debit and a credit on each side. And we'll label them the normal balance and the increase and decrease. So you can see sales is done here. It's a revenue account out of all of those choices. Debit is always on this side. Credit is always on this side. And the normal balance for sales is a credit balance. So we'll put that here. And a debit would decrease sales and a credit would increase the account. So our next one, prepaid insurance. It is an asset. And again, debit on the left, credit on the right. Because it's an asset, its normal balance is a debit, and it will increase with a debit, and it will decrease with a credit. Okay, accounts payable, Pacific Supply. Accounts payable is always a liability. Again, debit, credit, and in fact, we know that that's going to be the same for every single one, so we can just copy and paste that on every single T account. Debit's always on the right, or debit's always on the left, credit's always on the right. Okay, so liability is a normal credit balance, so we'll put normal balance here, which means that it increases with a credit and decreases with a debit. Advertising expense. Advertising expense is, of course, an expense. Expenses are increased with a debit, so normal balance on the debit side and increases with a debit, decreases with a credit. Supplies is an asset, which means its normal balance is debit, and it increases with a debit, decreases with a credit. And accounts receivable, Trent Associates. Accounts receivable is always an asset, which means its normal balance is a debit, and it will increase with a debit and decrease with a credit. Capital stock, it's part of your owner's equity section, which means it normal balance is going to be a credit, and it will increase with a credit, decrease with a debit. Petty cash is an asset, which means its normal balance is a debit, and it increases with a debit and decreases with a credit. So that should be the end of this work together problem. And you should be able to, in the same way, do these on your own by yourself. Okay?